Welcome back to Investing Talk Podcast. Today, we're taking a close look at a company whose upcoming earnings report might be, well, a bit different than what you expect. We're talking about Aegon, and specifically their first half 2025 results. They're due out on August 21st, 2025, right before the market opens. Our aim today is to help you understand why the usual financial metrics might not be the main focus here, and, crucially, what you should really be watching for in your research. Now, before we get into all the details, if you're finding these conversations valuable, please do hit that subscribe button, give us a like, and maybe leave a comment. Your support really helps us bring you more of this analysis. And hey, if there's a specific company you'd like us to look into next time, just let us know in the comments. And if you're feeling generous, maybe consider buying us a coffee. Your support truly fuels our research efforts. All right, let's unpack this Aegon situation. Usually when you talk earnings, everyone immediately jumps to, revenue growth or GAAP EPS. But Aegon seems like a fascinating case because their upcoming first half 2025 results on August 21st don't quite fit that mold.
That's exactly right. It's interesting because if you look at the major public data aggregators, you won't find a clear, up-to-date consensus estimate for their revenue or their EPS. And there's no reliable whisper number floating around in public sources either. That right there tells you this isn't your standard earnings beat or miss kind of situation.
Okay, so if we're not laser focused on revenue or EPS, what is Aegon guiding on? What are they telling the market to watch?
Well, Aegon typically guides on things like capital generation, specifically operating capital generation, often called OCG, and their solvency ratio. OCG is basically the cash thrown off by their core insurance operations. Think of it like operational cash flow, but specific to insurers. And the solvency ratio, well, that's absolutely critical for an insurance company. It shows their financial strength, their buffer against unexpected losses. And notice the event name, first half 2025 results. That phrasing itself suggests a strong focus on these H1 totals and those capital metrics rather than just a Q2 EPS number. For a global insurer like Aegon, these capital health indicators are paramount. They're really the bedrock of the business.
That makes sense, capital health being paramount. So digging into that a bit, if we can't really rely on the typical EPS history, what does Aegon's past performance tell us about what actually drives investor sentiment?
Yeah, historically, it's the same story. Those public aggregators don't show consistent quarterly EPS data for Aegon, partly because they often emphasize semi-annual or full-year reporting, and partly because the focus has always been different. Now, sites like Market Chameleon do track how the stock price reacts after earnings, but getting the specific percentage moves often requires deeper access to their data. So the usual historical EPS surprise charts you might look at are often sparse or just not there for Aegon on the mainstream platforms.
Right. So given that gap in typical data, what has actually been grabbing investor attention? What metrics consistently seem to move the stock after their reports?
Well, especially following some big structural changes they've made, like simplifying the Transamerica legal entities in the U.S., which was a big internal cleanup, and also the Dutch redomestication, moving their legal home base. Investor focus has really zeroed in on those key performance indicators, or KPIs. We're talking the solvency capital ratio, SCR, that operating capital generation we mentioned, and very importantly, capital return. How much cash are they giving back to shareholders?
Through dividends and buybacks, presumably?
Exactly. Dividends and buybacks, those are the metrics to watch closely, much more so than just top-line revenue growth. It really forces you to use a different analytical lens compared to, say, a tech company.
It absolutely does. And it raises an interesting point for you, the listener. How does this shift in focus away from standard EPS towards these more specific capital metrics change how you need to think about an insurer's financial health when you're looking at your sources?
It's a fundamental shift in perspective, really.
Okay, so we know what to focus on for the August 21st report. But looking beyond that specific date, what else is on Aegon's calendar that we should be aware of? Any other potential catalysts?
Yes, definitely. Looking at their company calendar, there's a Q3 2025 trading update scheduled for November 13th. That will give a more current snapshot later in the year. And perhaps even more significantly, there's a Capital Markets Day set for December 10th, 2025.
Capital Markets Days are often quite important.
They really are. These events can heavily influence future guidance, set the framework for share buybacks, shape dividend policy. They often lay out the longer-term strategic direction. So for long-term investors, that December date is crucial.
And thinking about the bigger picture, how do broader economic trends, especially interest rates, factor into this For an insurer like Aegon, it must be quite sensitive.
Oh, extremely sensitive. Life insurers, particularly in Europe where Aegon has significant operations, are very reactive to interest rate movements and credit spreads. Generally speaking, a higher for longer interest rate environment can actually be supportive. It helps their new money yields when they invest incoming premiums, which boosts capital generation.
Okay, so higher rates can be good on that front.
Yes, but there's a flip side. Higher rates can also put pressure on the mark-to-market value of their existing bond portfolios. This flows through something called Accumulated Other Comprehensive Income, or AOCI, which sits on the balance sheet.
Right, AOCI. That can impact their reported capital strength.
Exactly. It can directly impact their solvency ratio. So you really need to understand the broader macroeconomic landscape, interest rates, credit conditions when you're analyzing Aegon's capital metrics and their ability to actually send capital back to shareholders. It's not just about their internal performance, it's how that interacts with the global financial weather system, so to speak. And it's worth noting again, the public sources we looked at don't show any fresh, consolidated analyst EPS estimates or rating changes tied specifically to this upcoming H1 print. It reinforces that unique focus.
That interplay between internal metrics and external factors is key. Okay, shifting gears slightly to market signals. Do we have any sense of how the stock's been trading leading into this report? Or what the options market might be suggesting about expected volatility?
Unfortunately, the public sources we reviewed don't really give a neat summary of Aegon's recent price trend going into earnings. You'd really need to look at the ADR price chart directly yourself to get that context. And regarding options, specific data like call-put ratios aren't readily available in these general sources either. Market Chameleon does show the at-the-money implied straddle for Aegon around the earnings date. That gives you a hint of the market's expected percentage move up or down.
So it tells you the magnitude the options market is pricing in.
Exactly, the expected magnitude. But to get the precise percentage, you'd need to access their live data tables. It just highlights that for Aegon, some of those traditional technical or options-based insights might be a bit less transparent or easy to find compared to maybe a large U.S. tech stock.
It really reinforces that theme. You need to dig a bit deeper and look at different signals. Okay, so knowing all this complexity, let's think about potential outcomes. What does a bullish scenario look like for this August 21st report? What would get investors excited?
Right, the bullish case. You'd want to see strong first-half operating capital generation, that OCG number beating expectations. And critically, a higher solvency ratio showing improved financial strength. If Aegon then follows that up by reaffirming, or even better, improving its capital return plans, maybe hinting at higher dividends down the line, or announcing a more aggressive buyback, that combination could definitely drive the stock higher. Positive commentary around investment spreads, keeping claims stable, making good progress on those simplification initiatives we talked about, all that would reinforce a kind of beat and raise narrative, even without a headline EPS beat.
It's a beat and raise, but focused on capital metrics.
Precisely.
Okay, and on the flip side, what would trigger a more bearish reaction?
Yeah.
What are the red flags we should be watching for?
The bearish scenario would be the opposite, essentially. Weaker than expected operating capital generation, or maybe a noticeable dip in that crucial solvency ratio. That could happen because of market movements hurting their investments, or maybe claims experience turned out worse than anticipated. Also, a cautious outlook. If they sound hesitant about future capital returns, maybe signal they need to hold on to more capital, that would be negative. Any bad news on legacy blocks of business or signs of margin pressure in their main insurance lines, or even just costs running higher than expected, those could all add downside pressure to the shares.
So if you had to boil it down for our listeners, what's the single most important metric or maybe metric pair to keep laser focused on when the results hit?
I'd say the Solvency II ratio and the operating capital generation figure, those are the twin pillars. And right alongside those, any updates or commentary on their capital return plans, dividends, and buybacks for the rest of 2025 and beyond. Those elements together are almost certainly going to be the most influential drivers for how the stock reacts. They really get to the heart of Aegon's financial health and strategy.
Okay, summing it all up then. Given everything, the lack of standard consensus, the focus on capital, what's our overall leaning heading into this report? And what are some strategic thoughts for you, the listener, as you consider your own approach?
Well, given that limited public consensus on traditional numbers and the fact that this is so centered on capital metrics, our overall leaning is pretty neutral going in. The direction the stock takes the skew will likely hinge almost entirely on how those solvency and OCG numbers land relative to whatever quiet expectations investors have formed. It's not about a simple EPS beat. Our confidence score for predicting a surprise here, maybe a 5 out of 10.
So pretty uncertain.
Yeah, exactly. The timing of the event is clear, August 21st. But without those strong public benchmarks for EPS or a Wister number, and with the reliance on these specific capital metrics, predicting a surprise is tough. Plus, as we discussed, the outcome is quite sensitive to external things like interest rates and market moves, adding another layer of uncertainty.
Right. So for you listening, thinking about strategy around this event.
Okay, for more risk-averse investors, you might consider avoiding holding a position through the announcement if you can't get a good handle on potential solvency or OCG outcomes yourself. Alternatively, maybe use smaller position sizes to limit risk, or simply wait. Wait for the dust to settle after the report, listen to the commentary, and let a clearer trend emerge before jumping in.
What about options traders? Assuming there's enough liquidity.
If the options are liquid enough, a classic approach for an uncertain outcome is a delta-neutral long straddle or strangle. This aims to profit from a larger-than-expected move, regardless of direction, but you'd absolutely need to check the live implied straddle percentage from an options screen first. Compare that implied move to how the stock actually moved after past earnings. Market chameleon data can help there to see if the options are already pricing in too much volatility.
Makes sense. Check if the potential reward justifies the cost of the options, and for traders looking to bet on a specific direction.
For directional plays, it's about reacting to the key data. You'd probably only want to buy strength if you see clear evidence of a higher solvency ratio, strong OCG, and supportive language on capital returns right at the release. Conversely, you might look to fade any initial strengths or even go short if those crucial solvency or OCG numbers disappoint, or if the company sounds cautious about returning capital going forward. It's all about those specific insurer metrics.
So it really comes back to that core message. As Aegon heads towards August 21st, it's not about chasing the usual headline numbers. It's about understanding which numbers truly tell the story of this specific company's financial health and its future prospects. It really highlights how vital it is to look beyond the surface and grasp the unique reporting nuances, especially in complex sectors like insurance.
Absolutely. And perhaps that leads to a final thought for you to consider based on the materials you have access to. Having seen how Aegon requires this different analytical approach, focusing on capital, solvency, are there other companies, maybe in your portfolio or watch list, perhaps in similar complex industries like banking or asset management, where you might be missing the real story by only looking at the standard EPS or revenue figures? What unique metrics, what hidden capital health signals might those companies be sending that deserve a closer look from you?
That's a great question to ponder. Thank you for tuning into Investing Talk podcast today. We hope this look into Aegon's upcoming earnings gives you some valuable insights and maybe a new way to approach company analysis. Don't forget to subscribe, like us, and leave a comment with your thoughts or tell us which company to tackle next. We'll catch you on the next one.